What is going on with Tesla? It is down 34% year to date, making it one of the worst stocks, not just in the Mag 7, but in the complete S&P 500. We can see it is towards its 52-week lows, and just today down 6%. So we're going to find out the answers to the question is, why is Tesla stock dropping massively, and is it a strong undervalued buy now? Should we be looking to add it to our portfolio? We're going to look at the numbers. We're going to take a look at their revenue top line growth year on year, as well as their bottom line net income. We're going to take a quick look at the balance sheet, their health, their total cash versus their total debt. And we're going to see in the industry that they operate, are they the only ones having a very poor return, or are there others who are similar? We're also going to look and see what are the institutions doing, if they are also buying or if they are selling with the rest of the market. And we're also going to take a look at some notable insider sales that we have seen, some huge amounts to that. We'll look at their metrics, we'll understand whether or not growth is expected over the next few years, how has the performance of the company been historically, and as we mentioned, we're going to understand what is going on, why is this share price continuing to drop, and finally, we are going to run it not just through the valuation model. Yes, we'll get to our intrinsic value. Yes, our acceptable buy price given our investor margin of safety, and look to what Wall Street are forecasting. But we're also going to run it through our valuation model with 3 different members. We're going to look at the low, medium, and high growth rates to understand where our numbers are being driven from. So let's get straight into the performance. So we can see, whilst they are down 34% over the last year to date, we can see over the last 12 months, still down, but a better performance. Although if you have been a holder for 10 years or more, you would be up very considerably, over 1,000%. Now, we do note it is towards its 52-week low. It doesn't currently pay a dividend, and the market cap sits around 558 billion, with still a fairly expensive forward PE of 58.59. Now, in terms of today's drop, the main reason, as we can see here, they did release their first quarter vehicle production and deliveries report. Now, they essentially delivered 386,000, which is down 8.5% from the same quarter just a year ago. And as we can see from 11 different analysts, they were expecting for the first 3 months of this year significantly higher at 457,000. So it was a very big miss in terms of the deliveries. And when we take a look at how they actually performed in terms of their production, well, they did produce in the first quarter 433,000, but unfortunately they only delivered 386, which, as we mentioned, was far below what analysts were estimating, one of the key drivers for the drop in today's share price. Now, in terms of looking at the business as a whole, in terms of the top line, they are growing very rapidly. In fact, from 24.6 billion in 2019 to 97 billion in the more recent year. And we can see this isn't just over the last 5 years, but also gradually each year they are increasing those numbers, which is always a positive sign. When we compare that to how the bottom line looks, well, they did have a net loss in 2019, but since then that bottom line has increased rapidly, as we can see, all the way up to 15 billion in the more recent year. So top line is increasing at a very strong rate. Bottom line has also increased over the last 5 years. So the financial statements, in particular the income statement over the last period, does look very healthy. Now, a quick look at the health check of the balance sheet, so total cash versus total debt. 6.3 billion of cash in 2019, 29 billion in the latest quarterly report. So we can see they have built up a fairly sizable cash position. And when we compare that, which is important numerically and directionally, to their total debt, what we can see here is that it has in fact gone down 14.6 billion to 9.6 billion. So positive cash has gone up very rapidly whilst total debt has come down. This is what we'd love to see, making a balance sheet even stronger. So no worries there from the general overview. Now, in terms of the industry as a whole, the automobile manufacturers, we can see Toyota, Stellantis, as well as a few others. Now, what we're looking at the performance just over the last year, Tesla, as we can see, one of the worst performing, down negative 15%. And in fact, out of the 6, it is one of 2 with a negative performance. We in fact see Race very strong, up 58%. and TSLA up 64. Now, when we extend that over the last 5 years, we can see Tesla has been a very strong performer. But I want to make it very clear, especially in this case for Tesla, that past performance doesn't necessarily mean they're going to have the same performance over the next 5 years. So do bear that in mind and take that into account in your investment thesis. Now, in terms of institutional ownership, it does sit at 66%. We see a lot more, well, not a lot more, but a fair amount of sales, 38 billion over the last 12 months. But unfortunately, we don't see as much buying over the same period. So, in conclusion, effectively, over the last year, institutions have sold more stock of Tesla than they have been buying. Now, looking at the more recent quarters, we see Q3 looking fairly flat in terms of buyers versus sells. Q4 of 23 more buyers than sells, and in the more recent quarter, zero worth of buying and a little bit of selling. So overall, institutions are selling more than they are buying, just something to bear in mind with this company. Now, when we take a look at the essential insider buying and insider selling, we've looked at both transaction types over the last month, and we can see, in fact, a massive sell by one of the directors, in fact, not too long ago, just a couple of weeks, and he sold around 93,000 shares, combining total of around 16.4 million. Now, since then, the share price has gone down negative 5%, but I wouldn't necessarily say it's a bearish signal. Again, every investor will have different ways of looking at that, but remember, there are personal reasons, financial reasons why insiders may sell. So let's take a look at the metrics. Before we do, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as all of our other articles, all completely free, do click on that pinned comment below. So jumping into the metrics, now what we want to see here is free cash flow growth. We do ignore the earnings, but you can take a look. Data is available on screen. It is just susceptible to manipulation by the management through accounting. 2014 to 2018, they did go through a period of negative free cash flow. We do see that for, in fact, 5 years. Since then, though, in 2019, it has moved up very nicely, but do note two things. Firstly, it is expected to drop into 2023, or it did, in fact, to $1.37, but the increase is very minimal in 2024 to $1.44, so don't expect a massive increase to their free cash flow when they do release their full year accounts in some time. In terms of sales growth, well, 3 to 7% is our target for the more mature companies. Companies like Tesla, which are rapidly growing, double-digit increases to their top line, very positive to note. But it does look like it has slowed down over the last few years. We do want to see a very nice period of very high double-digit growth. So it will be interesting to see what their performance, what their guidance does look like for 24 and 25. But unfortunately, we have noted purely based on those delivered that it does look to be a lot less, however, than what the analysts are targeting. Numerically speaking, though, very rapid growth to their top line from 3.2 billion to just under 100 billion. Also worth noting, with Tesla, they do dilute your position over the longer term. As we can see, they have rapidly increased those shares outstanding. So one thing to note and consider when you are factoring in your margin of safety. ROIC, well, it was negative for quite some time. This is due to the fact that they did make a loss from 2014 down to 2018. Since then, though, it has gone up. I do want to see a minimum of 10% just to give me faith that the management are able to effectively allocate their capital, and we can see they have hit that over the last 3 years. Hopefully that does continue. In terms of the operating margin, well, we can see, again, they made a loss, so no surprises with negative operating margin. Since then, though, it has increased to highs of 17, but come down to 9 in the more recent year. We want to see, ideally, around 16%, so there is a lot of room for it to grow in 2024 and beyond to get to our minimum levels. Free cash flow margin around 5% or higher, and we can see they have pretty much there or thereabouts hit it over the more recent last 6 years. Something, again, just to keep an eye on, given how close it does straddle to that minimum 5% we want to target. Net debt to EBITDA, the earnings before the interest, tax, depreciation, and amortization. Remember, it does correlate to that balance sheet strength. Effectively, over the last 4 years and expected in 2024, it won't even take them 1 day to pay off all of their debt. So very, very strong. Remember, these numbers signal the number of years it would take the company to pay off all of their debt net of cash on hand. So no worries about Tesla's balance sheet. We did run through it as well. Very strong, given the fact that they did, in fact, go up in terms of cash and actually come down in terms of their total debt. Now, let's get into the valuation. Now, we will look at the DCF model. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we've gone for 3 different targets, a low, medium and high. Now for the medium we've gone for 30%, so this means they need to increase their free cash flow over the foreseeable future at 30%. It does seem fairly optimistic, so again factor that in. We have the free cash flow growth year on year. On average we do see it skewed given the fact that it was negative for quite some time. Forward looking then, based on the medium target of 30%, we get the discount rate and therefore we get the present value of the future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get a sign here of undervaluation. Now this, remember, undervaluation signal is based on a 30% growth rate. For the low growth rate, we have gone for 25%, and as we can see, that would be an intrinsic value of $131, giving an overvalued signal. So we can see here the low gives upside of negative 20%, the medium gives upside of 10%, and on the high, again, 35%, this would give an undervaluation signal, signaling upside of 50%. Now, these are all variable factors that you can put in depending on what you believe over the longer term. However, we've gone for a medium of 30%. Remember, if you do grab a copy of this valuation model in the pinned comments below, you can run your own numbers through based on your own estimates and judgments. So based on a 30% growth rate, if we do take it to our intrinsic value, now today's episode we are just using the DCF model. For other companies, we do use Graham's multiples and the dividend discount model. So $179.90 with the current price down today to $164. We do use a margin of safety of 10%. And we allocate on that if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. We can see it isn't quite there yet, but it isn't too far off now, a 10% MOS level based on that DCF valuation metrics that we ran through. You are getting a 5%. So for today's episode, we see a 5 to 10% MOS level. Now, in terms of Wall Street and their forecast over the next 12 months, well, they see upside of 22%. They do believe Tesla to be a strong buy now with a price forecast of $200 or just thereabouts. As always, though, do let us know your thoughts in the comments below. Is Tesla one you are adding after the drop that we have seen today? Does the news that effectively their deliveries are lower than what analyst estimates is a worry, or do you believe that actually this is an opportunity for the longer term of this company and you foresee in the future this price will be trading at a much, much higher price? As always, let us know your thoughts below. If you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next episode.